Ready for a deep dive? Today, it's all about options. We're tackling calls, puts, and all that good stuff. Got excerpts here from Ryan 2007, the Corporate Finance Bible, and then this really interesting chapter from Introduction to Options and Option Pricing.
Options are kind of having a moment.
They are, but why? What makes them more than just, Wall Street jargon?
Well, I think what's really cool about options is that they're not just for high finance folks. They can be a really useful tool for anyone who, say, wants to manage risk or maybe even profit from a hunch.
So like a secret weapon for the everyday investor.
Exactly. Okay, so let's say you're really into comic books.
I mean, who isn't?
Right. And there's this rare one you've got your eye on. Pricey now, but you have a feeling it's going to be worth a fortune later on.
Okay, what do you do?
Well, instead of shelling out all that cash right now, you could buy an option.
An option to buy the comic book.
Yeah, you're locking in the price you can buy it at later, even if the actual price goes way up.
So it's like a reservation on its future value.
Exactly. You're not obligated to buy it at that price, but you've got the right to, if you want it. Ryan 2007 calls this one of the main types of derivative contracts, along with futures and swaps.
Oh, right, those. Future swaps. Always sound a little intimidating.
Well, think of a future as setting today's price for something you'll buy in the future, like locking in the price of coffee beans months before you need them.
Makes sense. So that's futures. What about swaps?
Swaps are more about exchanging one kind of payment for another, which can be handy for managing things like interest rates on debt.
Okay, so options are more about that choice element. You have the right, but don't have to buy.
Yeah, exactly. And just like with anything else, there are different types of options, each with their own quirks.
Yeah, I was just getting to that. Ryan 2007 mentions American options, European options. There are even Asian options.
Right. It's a little much. Think of the different options like choosing a plane ticket. An American option is like that flexible open ticket. You can use it, or in this case, exercise your right to buy or sell any time before it expires. A European option is more like booking that non-refundable fare. You only get to use it on that specific date, the expiration date.
So if I want flexibility, I go American. If I'm feeling lucky and decisive, European it is.
That's a great way to put it. And then there are the Asian options, which base their value on the average price over a certain period.
Whoa, that's next level. But why so many different types?
It's about having the right tool for the job, right? Different options fit different situations and how much risk someone's comfortable with. Just like there's no one right way to invest. There's no one right option for every scenario.
So what makes one option more, valuable than another? Is it just the price of the thing it's based on? Like if we're talking stock options, is it just the stock price?
That's definitely a big factor. But it's not the whole story. Ryan 2007 actually breaks down 5 main things that drive an option's value.
Yeah.
The price of the underlying asset, that stock you mentioned, is one. But there's also the price you agree on for the option, that's the exercise price. And then there's also the risk-free rate of return, how long until it expires, and last but not least, volatility.
Okay, so it's definitely not as simple as just looking at the stock price. We've got a lot to unpack there. Let's start with that exercise price. So this exercise price, it's like the price tag you're locking in, right? But how does that actually, change how much the option's worth?
It's all about the potential for profit. Imagine this. You've got a call option, the right to buy. A lower exercise price is like finding a steal. You're locking in that lower price, so if that asset's price shoots up...
Jackpot.
Exactly. But here's the thing. There's always a catch, right? Time. That clock's always ticking down to the option's expiration date.
Right, so how does that factor in?
Time, my friend, can be both a friend and a foe. The closer you get to that expiration, the less time there is for the price to move the way you want it to. It's this thing called time decay, and it's a real factor.
So it's like the option kind of starts losing its power as you get closer to that deadline.
Precisely. And Ryan 2007 points out that there's also this thing called the risk-free rate of return, which basically means what you could be making if you just parked your money in a safe government bond. If those returns are high, holding on to an option seems a little less appealing.
Yeah. Why wait and see the option when you could be earning a guaranteed return somewhere else? It's got to be about balancing that potential reward with how much risk you're willing to take.
Exactly. Speaking of risk, let's talk about everyone's favorite, volatility.
Okay, I have a feeling this is where things get interesting.
Oh, absolutely. Volatility is all about how much the price of something, that underlying asset, swings up and down. High volatility. Get ready for a wild ride because those price swings can be huge.
So it's the difference between like a lazy river and a roller coaster.
Perfect analogy. High volatility generally means pricier options because there's a bigger chance of, like, a massive payoff, but also a bigger chance of, well, losing your shirt.
Makes sense why some options traders are basically adrenaline junkies.
Right. But there are ways to manage all that. Introduction to Options and Option Pricing actually talks about using options for hedging, which is kind of like taking out an insurance policy on your investments.
Instead of betting it all on black, you're creating a safety net.
Exactly. So say you've got some stock and you're a little worried about the market taking a nosedive. Buying a put option, which is the right to sell at a certain price, could actually help offset any losses if the stock price tanks.
Okay, so options aren't just for high-stakes gamblers after all.
Nope.
Speaking of which, earlier we mentioned that Introduction to Options and Option Pricing told this really cool story about, what is his name? Thales, the ancient Greek guy who predicted a huge olive harvest.
Yes. Thales, the original options trader, he basically bought the rights to all the olive presses in the area when no one wanted them. Demand was low. Prices were cheap because he knew a big harvest would send demand through the roof.
And it did. He made a killing, right? That's amazing that this whole idea of options has been around for centuries.
It really has. And then fast forward to the 1970s, that's when the Chicago Board of Trade helped shape the options market we know today.
Wow, talk about a glow up. From olive presses to, like, Wall Street trading floors.
So on that note, let's talk about one of the tools of the trade. What about this Black-Scholes model I keep hearing about? This mathematical formula for putting a price tag on options.
Yeah, it's a pretty big deal. Fisher Black, Myron Scholes, and Robert Merton, they developed this model that looks at things like the current price of the asset, that exercise price we talked about, time to expiry, volatility, all that good stuff, to calculate an option's theoretical value.
Sounds seriously complex. But like any model, I'm guessing there are some limitations. For sure. One of the big ones is that it assumes volatility stays the same, which, never happens in the real world. And we know markets aren't always perfectly efficient, which is another assumption the model relies on. In fact, there have been some major trading losses because models like Black-Scholes didn't quite hold up in the real world.
Right, because markets are unpredictable.
Oh.
So Black-Scholes, that works for, like, most options. Or are there some it doesn't work as well with?
Good question. Remember how we were talking about those American options and how they're like the flexible plane ticket? Well, Black-Scholes works best for the European options, the more rigid ones, because it assumes you can only exercise at the very end on the expiration date. When you've got that flexibility of the American option, you need a different tool.
And this is where those binomial trees come in, right? They sound more like something out of a botanical garden, not a finance textbook. Binomial trees, they sound more like something you'd find in a forest, not talking about finance. But Ryan, 2007, uses them to explain how to value those, more flexible American options.
So how do these trees help us navigate the options forest, so to speak?
It's all about visualizing the possibilities. Imagine like a map of every way a stock price could move up, down, sideways, you name it, between now and when the option expires. That's kind of what a binomial tree does. It breaks it all down into these steps.
So instead of just one path, we're looking at like all the forks in the road.
Yeah, exactly. And at each step, you've got these two possibilities. The price can either go up by a certain amount or down by a certain amount.
Okay, so we're basically weighing the odds at each of these points.
Right. We use those up and down movements along with that risk-free rate we talked about earlier to figure out how likely each path is.
So this is where it gets kind of mathy, I'm guessing. It does, but the cool part is that we work backward. Starting from the expiration date, we go back in time, figuring out what the option would be worth at each step on the tree. And because we're accounting for all those early exercise possibilities, it makes it perfect for valuing American options.
So it's like we're retracing our steps on that choose-your-own-adventure map and seeing what the best move would be at each turn. That makes sense.
Exactly. And while the actual calculations can get a little, involved.
Spare everyone the math lesson today.
Right.
Yeah.
But just know that binomial trees give us this really practical way to put a price tag on those more complex American options.
Okay, so we've got Black-Scholes for our European options, binomial trees for our American options. Sounds like we're covering all our bases.
Almost. Ryan, 2007, also mentioned something called put-call parity, which I know sounds kind of scary at first.
Yeah, a little bit.
But it's actually a really elegant concept. It boils down to the relationship between the price of a European call option and a European put option on the same underlying asset with the same exercise price and expiration date.
So like Two sides of the same coin, kind of.
Exactly. And it all comes down to something called arbitrage. Basically, if there's a way to make a risk-free profit from price differences, traders are going to find it.
Always got to love a loophole.
Right. And then when call options aren't in sync, reflecting this parity, then someone could swoop in, make some trades, and boom, risk-free profit. But that buying and selling would eventually push those prices back into balance, maintaining that put-call parity.
So it's like a self-correcting mechanism in the market.
Exactly.
Wow. This deep dive has been a wild ride. We started with, like, ancient olive harvests and ended up talking about complex mathematical models.
It's amazing, right? How something that started with olive presses could evolve into such a sophisticated financial tool.
It really is.
Yeah.
And for anyone who wants to go even deeper down the options rabbit hole, which, let's be honest, after today's episode, who wouldn't?
Right.
Ryan, 2007, Introduction to Options and Option Pricing. Those are your go-to resources.
Absolutely. And whether you're a seasoned pro or just starting out with options, the key takeaway is to never stop learning.
Couldn't agree more. Well, we hope you've enjoyed this deep dive into the world of options. It's definitely a wild world out there, but with a little knowledge and a bit of caution, who knows? Maybe you'll discover some profitable opportunities along the way. Join us next time when we'll be exploring the fascinating world of Shay. Insert next topic. Until then, happy learning.